An extraordinary thing is happening in the markets. Usually when stocks are up, another type of asset, often bonds, it goes down. Money flows out of one asset class and into another. Yet lately, it seems like everything is up, way up. And some experts say something's got to give. Something's got to take a tumble. So what's it going to be, boys? We got our bulls and bears to tussle over it. But first, guys, let me give you a few key numbers. All right, first let's start with stocks. All right, so stocks are up 57% since the lows of March 9th, right? But look at this. Oil is up too. Boom, it's up 54% since early March. And gold is up 10% in the same time frame. Even treasuries, guys, demand and prices should have plunged now that we're past this crisis of a year ago. And given that, we've had a huge increase in the supply of T-bills. When supply goes up, then prices fall. So that would mean that the yield on those bonds, the interest they pay you, should be way, way high because the prices are so much lower than they were a year ago. Yet, look at this. 10-year Treasury bonds are actually priced higher now than they were last October in the thick of the Lehman Brothers catastrophe. The demand is so high that the 10-year bond yields now are actually lower than they were in the panic. The yields are down 63 basis points in that time. The 10-year now paying a return of less than 3.4%. Last October, at a time of huge fear, the yield was over 4%. This means prices of treasuries are going up too. Heck, even the most abused and battered asset of all, real estate, showing signs of life. Look at the top 50 REIT index. It has doubled since their lows. Let's start with Steve Stoller, our biggest equities bear. Which one of these asset classes is due for a tumble? I'm thinking you say stocks.
Oh, I say stocks. I think this broad-based stock move has been really overly optimistic. I think we need to be a little more picky as to where we go from here. Yep. I like the real estate. It's shown itself.
Okay,
it's
Bob
paying a great
Phillips,
dividend.
Tell us why he's wrong.
Dennis, thanks for having me on. I believe he's wrong because the overall trend that we're seeing in our quantitative patterns shows very, very, very strong support for stocks. It's been a narrow rally. Individual investors are underinvested. Institutions are underinvested. You can look at the amount of cash in institutional money market funds as well as retail money market funds relative to market valuations, and it's still extremely high.
Okay.
So people are having to buy into this rally.
What about the Merrill Lynch report? They came out with a survey, Dennis, from the August survey, which I emailed to you. I was shocked because what they found was that mutual funds have the lowest level of cash, the highest level of stock since July of 2007. So I remember talking about these high cash levels in the cash tsunami, but yet, according to all the surveys of money managers, all the cash is in the system.
Go ahead. Who else?
Yeah, the managers, the money they have that got invested, but look at the money that was taken out since last November, tens of billions of dollars, hundreds of billions of dollars, that has not been put back to those managers to reinvest.
No, there's $3.5 trillion sitting in money markets. Let's try to split a tire. Say, Scott Redler.
All right, first of all, the money that was taken out back when the market had its swoon was probably mechanically sold out because those were people who couldn't handle their portfolios.
Right.
Those were guys that were on margin.
Okay,
those were institutions that were over-leveraged. So that money might not be coming back. As far as new inflows coming in, a lot of it's from the retail investors. So that supports the thesis that people are starting to come back because of the excitement. And when excitement comes to the market, that's when you have to be a little bit cautious.
All right, so Scott, which asset class tumbles first? Stocks?
Well, I don't think that we're going to have a tumble. I just think we're going to be in the same type of uptrend we've been in, whereas if you buy stocks after a 7 out of 8 day up move, you're going to have to withstand a 3 to 4% correction.
Two steps forward, one step backward.
One of these times that this 3 to 4% correction happens, it's going to wind up being more. And if you chase the move, you're going to get caught, and you're not going to know what to do. So entries are key.
Tom Lydon at ETF Trends looking at stocks, bonds, gold, oil. What asset class is going to go down? They can't all stay up forever.
Well, the scenario you're describing, Dennis, is rather than having a correction in September and October, we could in fact have a melt-up. There's no incentive to be in cash right now, and as investors are seeing this market move, and as you point out, close to $4 trillion on the sidelines, that money's going to start flowing in, which is just going to exacerbate this whole move to the upside.
Steve,
I think
what do you say to that?
Commodities will continue to be on fire, and rather than buying oil and gold, by the miners, by the service equipment companies that have done so much better than the spot price of gold or oil.
Right.
I agree with that.
We're starting to run out, so we got to go around the horn pretty quickly. And I just want to hear each one of you pick which of those major asset classes is the place not to be for the next 4 to 8 weeks. Okay.
Okay.
So
I'll
Scott
tell you right
Redler,
now where not
Scott
to be.
Redler, give us one.
Okay, for the next 4 to 8 weeks, I don't think you need to be in oil long. I think you could be in gold. Gold had a nice breakout. It could continue higher.
All right, Tom Lydon, what do you get out of for the next 4 to 8 weeks?
Run from treasuries.
Run from treasuries. Okay, Lee Munson, quickly. What do you bail?
I'm with Tom. You got to short treasuries right
okay,
now.
Bob Phillips, you're getting out of stocks, right? No, you like it.
No, I'm not. No.
Yeah, what are you getting
out of? Paring back my high-yield bonds.
High-yield bonds, okay.
Dennis,
And
Dennis,
Steve Stoller, you're going to get out of
sec.
stocks, right?
I'm going to get out of stocks, yes.
Okay,
Dennis.
you old fraidy cat, you. Guys, I'm sorry, but I have to wrap. We're under real time constraints. And to all you folks out there in TV land, email me, will you, at CNBCreports@cnbc.com. There's a lot more ahead tonight on CNBC Reports.